estate news, aka investment news on Build This City. And the first installment really talked about what the heck is happening right now and how are we going to navigate, right? And we talked about some of the key factors you need to look into. And now we need to look at how do you assess your situation outside of some of the key factors that I threw up on a PowerPoint for you guys, just validating some of the things you need to look at. Now we take a look at the numbers, and then we try to understand where we're headed from a real estate perspective. It's quite easy for me to kind of go on assumptions and make these and say, hey, I think we're probably headed to a place where there's not going to be much movement. And the reason why I say there's not going to be much movement initially is because of these guys. Right now with the coronavirus, as you can see from a spend perspective, you can see how all the countries around the world are spending in the billions to try to prop up their economies to survive amongst the big death toll of coronavirus around the world. And the U.S., of course, being the strongest and I would say highest debtor nation, also holding the world reserve currency, has spent approximately $2.3 trillion. That's a lot of money, folks. That's big, big money. So when you look at that, you have to step back and acknowledge that there has to be an opportunity here to make some more money in the market with this much money going into it. I mean, literally $2.3 trillion is probably several of these countries' combined GDP. If you're throwing that into the system or making it available, because just because they put in 2.3 trillion doesn't mean people will take it, because they have to take it. It's still a quite amount of sum that tells a story of something has to happen. Whether good or bad, we'll jump into some of the things I think will happen with this stimulus and what it entails and how it affects your investment. So let's do a quick breakdown of what's in the stimulus. I went to Politico. I went to a couple websites. I like Politico. It's kind of open book, and you kind of look at it. Focused in on the real estate industry. Let's go from the top because everything matters. Remember, we talked about the key factors: housing, wages, things like that, right? Housing meaning what's around you to make your house go up. What are the wages in that area, right? Okay. How are people doing from a debt to liquid ratio? Those are key factors. So they beefed up unemployment. There's about 13.3 million worth of jobs lost, I think, by now. So I pulled up a chart. I believe it was here. Unemployment rate by worker, by class, right? And we looked at agriculture and related private industries as the highest gainer there of unemployment amongst, and it's weird, right? Why is agriculture there, but there's a lot of inside of that of what's driving that high unemployment. Then you have leisure and hospitality. We talked about Airbnb, goodbye, see you later, right? No one can go anywhere, so you're stuck. Hotels are down. Construction, that is a surprise to me because in some states there are essential services. I would think they would continue to go up, but they're also down. Close proximity working, a lot of things like that could have played a factor. Mining and quarry, oil and glass extraction makes sense. Energy sector goes down when you're not working. Transportation, utilities, like all these make sense, right? Wholesale and retail trade, that is a question mark for me. But then again, you can't get more sales if you can't reach out to anybody. People are just transferring over to the virtual world. That's why you see stocks like Zoom start to rise up pretty high. So again, there's an opportunity here. I think that actual industry may turn around to something different in the future. Professional businesses, services, that includes real estate. Again, face-to-face sales type of deals. Even ones where you have to make phone calls because so many people are calling right now. Difficult areas to gauge. I think with the virtual system, we'll start to see a turnaround in those guys. But again, these are the guys that are affected. So now, the impact. What is your area concentrated in, right? What do you have in your area from a housing perspective? And that should give you a notion of where you may head from an unemployment perspective, right? Or where your prices will be in the future. Because if no one's working, usually, depending on how the plan goes with the stimulus recovery package, you may see a drought in the number of people living in your area that can pay bills within the 5 to 6 month frame. I don't think it'll be 3 months because of the forbearance, which we're going to jump into, but within 6 months, I think that's when we'll start to see the hurt. If they're living check to check, they won't be able to sustain, and there may be some more programs that come out based upon what I've seen the administration has done in current state. So now we go into the guide to the relief options. I talked about unemployment benefits. They're going to send up to $1,200, right? Everyone knows about that, right? People who are unemployed get an extra $600 per week for about the 4 months, okay? They beef that up on top of $1,200 stimulus check going to each person. So that's huge. That's $2,400 a month. I don't know if it's gross. Probably is gross. Maybe non-taxable. I haven't looked at that verbiage. But $600, $2,400 a month. A home that costs around $1,900 a month, is in the $280, $290 range. So most folks under $3,000 a month can pay their way out with unemployment benefits for up to 4 months. Okay, that's huge. That's huge. Okay, and by the way, this is $600 per month on top of the unemployment. So $2,400 just for the extras. And then you get, I don't know, $300, $400 for unemployment. Never been on it. Hopefully I never have to be on it, but it is what it is. That's quite a considerable amount of money just for unemployment. You're probably looking at 30-something thousand a year just free. So people are worried about, again, overstimulating and have people stay off of work. And then you got the loans. $500 billion going out to the loan industry, to the treasuries are hooking up some of the loan depots and saying, hey, you want some money, I'll help you out. And this is where it comes into play, right? The Treasury Department comes up, says they're going to give out $500 billion. Good opportunity for them to start ringing it in and making some money here. So Treasury stated, this is what we want to do here as far as support our industries, support the loan brokerages and things of that nature. And now there's an opportunity for you to get some loans from banks if they decide to lend, or they decide to hold themselves still with all of the rent issues they're going to see. And renting means, I'm talking about their mortgages. So they may decide to hold and not lend, or they may decide to lend at a higher cost because there's going to be such high demand for either forbearance or I assume new loans. That's the other thing we got to look at here. As this rate goes up, and if you think you're going to be gone, what do? You go, you know what? Let me beef up and just get a house now, because at least I can be in the house for X amount of time. While if I'm in an apartment, they're going to kick me right out. So that's some of the logic that goes through when you look at this in this revolution of the coronavirus and what we're going to see on its exit. Okay, so that's a big player, loans, and they're being backed by our federal government. We talked about the $1,200 stimulus. On top of the $600 per week in unemployment, we get the stimulus. What are all these things telling you? I'm going to stop there. Hospitals get some money, right? We talked about, they need equipment to be able to support. All these things tell me, hey, government's supporting right now. We may not see the crash that we expected. And in order for this country to come out of this thing, it's not going to be a savings environment. I think I will get into another video on the Japan economy and how they kind of let some of their big banks fail and what happened to them. We're going to get into why the government's going to have to spend. There's a couple critical things that happen, in my opinion, when they do spend, and we'll go over that to show maybe the spending is not such a bad deal when you look at it. Again, the breakdown of this $2.3 million. Then you got the small business loan up to $10,000. A lot of folks apply for that. Okay, credit to households. Again, so many different programs. More term asset-backed securities. New word for mortgage-backed securities. I'm sorry, government, but again, all these protection cases. $85 billion of worth up to insurance on that. You gotta say to yourself, what really happens here? It feels bad. It looks systemic. It's probably the highest unemployment in the shortest amount of time. But all these government-backed programs tell me if they really come through, they're still going to support. All right? Mortgage relief funds. So let's get into detail on that guy. Maybe this should be a separate video. You know what? I will do it as a separate video. All right, so now we got our numbers. And I stated, how do you look into your market? There's a special place that no one knows about. I'm joking out loud, called the St. Louis Fed. Okay, and if you go there, or if you just type in Google home index prices in your particular area, you can kind of see the waves of growth within your area. I start with San Francisco, probably the highest priced area. You're asking yourself, are you in a bubble? Are you in a bubble? Where's my employment inflation So I'm going to bring this over. This is the employment cost index. Okay, this tells us about our wage inflation. I talked about the money that you make tells you how much you can afford. Generally, 3 times your salary is what you want to pay for a home. All right. If we look at this, the home price index, this doesn't tell you how much they particularly make. This is not saying workers make $113,000 a year. Okay, it's not telling you that, but it's giving you the total in totality, the variance in points that the wages are going up. So you can kind of do some type of X factor, right? If the average salary is $45,000 and this goes up, let's say this is up 20, you can, I hate to do that. You can add 15 to 20 on that 45 or 40,000. You're up to the 60 or 56, 60 type range for salaries. 3 times that's $180,000 house. So if we start here, we go from the crash back in 2009, we were at 111 points, and then we went all the way back up to 132. That's almost 21 point move. Okay, that's huge. That's huge. And in the context of wage inflation, that's not bad. 22 points. All right. Now, let's go to San Francisco's home price index and see how many points that has moved. So San Francisco in 2009 was at 120. Look at this move. Right there, you should have stopped. Okay? Right there would have been the same move as the wage inflation that we just looked at. That was it, right? 132 to about 111. Again, simple math here. 123, 120, couple dips, then it jumps up to, they're at 178 and 14, and now they're all the way up to 269. If that's not telling you there's a bubble, what is? What is? I mean, I'm not an expert, but isn't it simple math? Something's wrong in San Francisco, but we know of all the tech money that's come in there and a new development. So it may not be a decrease as some may expect. I think maybe you'll see in some of these areas a 10 to 40% decline at maximum, just due to our youth and the number of technologies that are coming out. Let's do another market. Let's do one of the smaller markets, Phoenix. Phoenix may have an opportunity to hold still. Back in 2009, they're at 104, and then they jump up to 199. Hello, California. What happened there? So everything, 20-point move. This is about a 70, 80, 82-point move, right? Or 85-point move. If you look at it here, I take it from 104. That's crazy. All right, that's crazy. That's crazy. Actually, it's more than that. God forgive. I can't even count. 95-point move up versus the 20-point move for the wage index. You don't count them in the same way, but I just want to look at the percentage move, and simple math tells you something's up. Let's go to some other areas. I want to, forget about Seattle. We already know where that's going. That's just ridiculous. Those West Coast areas. Let's go to NYC. 213, right? Went down to 161 or 160, and now it's up to 203. So NYC is pretty steady, right? They went up 40 points. The total wage, and by the way, I'm doing the employment cost index for all of the country, so it skews the number a little bit, right? So let me just do a search real quick. If I do employment cost index, New York City, hopefully it pops up. Of course this is not, right? Because I'm doing it real time. When you do stuff real time, it just jacks you up. It won't give me. And BLS.gov is the website. Not the chart I wanted. And I'm not going to kill the meeting Let's see if this may work. This employment cost index. Ba ba ba. Ba 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 ba. So singing along a song, not working out, but again, if you can find your adjustment, right, based upon those numbers and see where it takes you. Again, I want one specific to NYC, and I didn't get that. So we got the overall look at the matrix, and obviously NYC is above that matrix. We just looked at that, but not too high. They still haven't respectively caught up to their prices in 2006, but they're pretty darn close, almost 12 points behind at this time. So they may not suffer as much of a hit as San Francisco and Seattle. Okay, here goes another market, Miami. They're another guy that was, pretty much out in the woods, 144. They jumped up almost 100 points, folks. Jesus Lord, why? 100 points and 20 points in wage inflation. That's nuts. Dallas, another guy, right? They're at 119, and they jumped up to 192. You're looking at 80-point moves versus a 20-point move. All right? Let's go to some more linear markets. I want to get to some of the smaller guys. Charlotte, North Carolina in 09 was at 118, and they jump up to 167. That market, as I mentioned, due to the growth and things that are going on there, they may not have as much of a decline as expected in some other parts of the nation, such as San Francisco, Dallas, right? Those guys with a 100-point market difference. Let's go to a smaller market as well, Tampa. Okay, this guy was at 235. It went down to 140. And hello, how are you? Look at that, boom. They're up to 225, all right? From the 140 range. That's my market. That's a big, big increase. I expect a big decline. Maybe back to the 185 level from the 225 level there, right? That's a little bit too high. Maybe even lower. Maybe to the 170. You kind of revert to the mean. You need that new mean, and it's not there, right? So what's changed? Obviously, you look at the Clinton initiative for home ownership really spiked it up, and allowing the banks to jump in and use the houses as an asset made this just a business now, and that's why you're seeing these up and down swings, because it's being treated like a cyclical business, and that's a shame, but it is what it is. So does it totally fall out? I don't think so. I think it's either going to be a market where we don't see that much incline in prices. Maybe we see a Japan-like scenario such as this, where it just stays steady, doesn't move too much, 2 points, right? Or we just revert to the same trend line and it dips down, we have a big drop, investors buy in, reinflate it up, and we sell. So several different options there. The market's telling me that it's inflationary pressures and that we're going to be spending money. So my assumption is that this will come back up after we see maybe a slight decline, all right? Now, jumping out of that, the next factor that we got to look into is builder costs. That's the last area I want to discuss today for housing assessment and where we're going to go. What are the building costs, and does the building cost reflect accurately what happened with the housing costs? We can start with San Francisco as an example. July 2009, let's give me a 120 or 121, all right? Close enough. We're in that range for building costs. And now we're at a 154. So if you only went up 30 points, how's this guy going up 100 points? Right? Where's the San Francisco? How's this happening? Seattle. Right? If your builder costs went up to 30, 40 points, how are you going up almost 100-point variance in Seattle in some cases? So that is a red flag that something's going on. Prices are too high and inflated. Can it go higher? If you're in a market specific, I know Tampa a little bit better than others. I live here. I know there's a lot of growth in certain areas. There's going to be certain pockets that make it and certain pockets that don't make it. But overall, this data can help you assess how far you may go and also help you with the decision point. Should I stay or should I go now? That's what you're going to have to figure out now when you look at these numbers. And the Fed kind of gives you that detail on what they're going to do to back us up. So you got all these things here as X factors. I want to sign off now with Build the City News for the next topic. We're going to get into, hey, what happens with these loan back programs and how does it ultimately affect the market? And then when will we see these declines? Because if you look at the housing market, it just doesn't drop right away. We had the crash back in 2006, And look how long I've talked about it. It took about 4 or 5 years to really feel itself out and get to its bottom. Housing is a less sharp of a decline than there is in the stock market that we just saw, or it should be. It may change. So we may have a little bit of time for all of you investors out there trying to flip a property, or those investors that are hoping and patiently waiting to sell their property. May be the best time today with 0% interest or low rates or lowest rates you can get in a market full of uncertainty, where some of these buyers will think that having an asset is better off than having nothing. Build this city. I'm signing off. Stick your notes in below, just giving you a little bit of information, helping do the work and actually showing it to you. I'm out of here. Hope to see you again tomorrow. Goodbye.